I'm Chris Preston,
And I'm Brad Simmerman.
and welcome to Street Check, the best podcast in the illustrious 50 plus year history of Cabot Wealth Network. We're going to get into a lot of investment related topics first or today, but first, Brad, you're a recovering um, food poisoning victim this week. Lettuce, I believe. Lettuce.
Uh, that's my assumption just based on what everybody ate and what I didn't. I slept, I don't know, 66 out of the last 72 hours with a few hours carved out for work in between.
Yeah.
Absolute nightmare, but seem to be on the other end of it. Do not wish that on my worst enemies. It is no fun.
Well, lack of food will clear your mind for a good, a lucid episode today, I
And
think.
I'll jumpstart my weight loss journey as well.
There you go. You're doing your New Year's resolution a month later, just not the way you wanted it.
Well, the full New Year's resolution or like in 3 days, right?
Right.
Like you lost
Yeah.
10 pounds from not eating for 3 days or drinking anything. So
Yeah.
it's
That's the
good.
way to go.
Good
Get
jump
it over
start.
with.
Yeah,
Yeah.
exactly.
All right. Tell people what we're going to be talking about today.
All right. So this week we are going to talk about some divergence in the Magnificent Seven, the narrowness of the equity rally in general, whether that is cause for concern and what sort of the street thinks about it right now. We're going to talk about New York Community Bancorp, NYCB, that fell on concerns about commercial real estate contagion for the regional banks. Is that going to be a problem? And we're going to talk about the Super Bowl coming up this weekend, or the big game, as the NFL might prefer that we call it. And more specifically, we're going to talk about some of the sports betting stocks and whether there's any kind of actionable uh, steps that we can take as investors to better position our portfolios because of it. Then after that, we're going to have Michael Brush on from Cabot Cannabis Advisor, who is going to talk all things cannabis with us. But before we start, as always, we will be defending only the hottest of takes. Chris, this week you are on the clock. Your take, the S&P 500 will weaken as the S&P equal weight strengthens. You have 90 seconds. Go.
Yeah. So S&P is now now above 5,000 for the first time ever. It's up a little over 5% year to date. So that's through the first 5 weeks, 6 weeks of the year. Nasdaq up more than 6%. Seems like the market is unstoppable. You look at the equal weight index, and it is almost exactly flat for the year, about 0.3%. That wasn't the case in November and December when the rally finally broadened from just the Magnificent Seven, which we'll talk about as you mentioned later, and AI stocks, and was hitting basically all sectors. Well, now it seems to be reverting back to just a pretty narrow rally, mostly not just the Magnificent Seven, but a tech heavy rally, whereas the average stock is flat to worse. Well, I think with everyone agrees that tech is pretty stretched, and I think there's a comeuppance happening. Even though betting against the Mag Seven is not been the best bet, and I think when that happens, it'll be a rotation. I think it's still a bull market. People will rotate into some of the sort of long neglected sectors, non-tech sectors, realty, other sectors. I think, sorry, not retail, not realty. And I think equal weight will get going around the same time that Mag 7 and others start to pull back. I probably went beyond 90 seconds there.
Hit the post. Good job.
Great. Okay.
Uh, yeah. So the one sort of devil's advocate thing that made me think of, I was reading an article, I think in Barron's yesterday, that was talking about how the rise of passive investing and underperformance of active managers has pushed even more money towards the obvious winners, right? Like if I'm your average investor and I see the stock market's at all-time highs, well, I can go out and buy individual stocks, or I can do the easy thing and just buy the S&P 500. Well, that means that 30% of my money is going to the Magnificent Seven, while
Yep.
70% goes to the other 493 stocks. So I wonder if there's maybe a case that even broader retail participation is going to continue to overweight it if it's coming in the form of just passive strategies like index fund investing. I mean, obviously, if retail investors just see the Magnificent Seven flying high and say, "Yeah, I want a piece of that," that'll lead to it. But I also think that there's like this undercurrent of maybe underinvestment of names that would, in most other environments, be really attractive.
Yeah, and I wonder if we've reached the point because people are so in on I'm starting to hear just anecdotally around here people talking about AI slash NVIDIA and not as much Meta, but all just by Amazon. That's the only way to go. We talked a little bit about that last week. And it seems like that's one of the telltale signs when you start, the average sort of non-investor or casual investor is sort of all in on a certain sector or theme. That's when it starts to go the other direction. So yeah, I think equal weight index is sort of in a pause right now after a big run up in November. December is up 13%. Even more than the S&P in November, December, and I think it'll hit another sort of leg of its rally, maybe as some of the big tech cools off a bit, because right now it's red hot.
Yeah, let's get into the Magnificent Seven
Yeah.
in earnest, though. Part of me wonders, like, I wonder if it'll take maybe an earnings miss. Like Tesla obviously missed on theirs, and
Yeah.
what that prompted was people just trying to reclassify the narrative. So now the trendy thing that's being thrown around is the M&M portfolio, Microsoft, Nvidia, Meta. So instead
Mhm.
of the Magnificent Seven, it's the M&M three, right?
Yep.
I've heard it referred to as the Magnificent Three and the Devastating Three, with Tesla, Amazon, and Google underperforming like over the last 2 years. I've heard the AI 5 thrown around, the three AI amigos, and I looked for it, I couldn't find it, but I saw somebody call it something, I think to the effect of the Magnificent Two and the Lackluster Five, right? So right now we're in
We
sort of
should call this podcast that if we bring five of our other analyst guests on sometime.
be the Magnificent Five and the Lackluster Two then.
Yeah,
Uh,
well, fair. Yeah.
So, so I do think that maybe that narrative pairing is still some sign of resistance that people are not ready to give up on the Magnificent Seven trade yet. But maybe if we saw one of the still outperforming stocks come in with some mixed results at some point, people would, I don't want to say give up, but say, hey, let's diversify out, or you need something more definitive than just Tesla coming out and missing. Tesla gets a lot of flack for a lot of like non-business related reasons anyway with what Musk does, and then there's valuation concerns. So I do wonder if it'll take more than just Tesla underperforming or a little bit of divergence from the other six for us to really start seeing investors come out and say, all right, that seems like I missed the boat on this one. Where else do I have an opportunity to make money?
Right. Yeah. And the problem is that it seemed like Jacob Mintz, who we had on this podcast last Friday, sent us some stats of what was it from? How long ago was it from? When people were started talking about, you know, bubble about to burst on the Magnificent Seven, and every single one of the stocks was up. Well, not every single one, but
So 6 months ago,
yeah,
that's when we sort of got into talk about peak AI
yeah,
bubble, which I don't recall at the time. I don't think we were calling peak AI bubble. I have been guilty of calling the top for Magnificent Seven in the past, so
yeah.
I'll take the L there.
I think I just did too. So yeah, you're not alone.
So since 6 months ago, Microsoft's up 27%, Meta's up 50%, AMD, which is not one of the Mag 7, but is obviously a chip maker, big
Yeah,
part of the tech strength, up
yeah,
55%, Nvidia's up 56%, and now ARM is up was up something like 48%. They had a really positive earnings reaction just the other day.
yep,
So I don't know, maybe we need a replacement narrative instead of just big tech companies with tons of cash. It becomes, all right, well, the chip sector is actually this really
yeah,
powerful sector. So maybe we broaden out by sort of stepping to the side instead of stepping back.
Yeah, I mean it's I harped on the Mag 7 and in my defend the take, but it's not just the Magnificent Seven now the way it was for a lot of last year. There are some uh new emerging leaders. You talked about AMD just now. A crowd strike.
Pal Palantir had a
Palantir,
really
yes.
strong response
Yeah.
to earnings because I mean they were really heavily shorted, but
Yeah.
their AI tools were making an impact. So maybe we
I,
get
even
like
IBM has joined the
yeah.
fray, which has been, sort of an unloved stock for a while. And that's sort of because of good earnings and an AI sort of spin. This is what Watson X something is getting some love now. So yeah, tech is on fire. How long that lasts, we'll see. Maybe betting against it is a bad idea. It has been for the last 6 months, as you just referenced. All right, let's move on to something that's not red hot. Regional banks. The New York Community Bank is the latest sort of victim to well, I guess it's still sort of hanging in there, but the stock is down 60%, and it's because of its exposure to a commercial real estate sector. High rates and low occupancy is not a great combination, and uh, they've just got its third credit rating cut, Morningstar, yesterday, after Fitch and was it S&P?
So Moody's, S&P, and Fitch are the
Moody's,
three.
sorry, yeah. And now some German and Japanese lenders are worried, and other parts of Europe are worried about exposure. It seems like, how much should we worry about this being yet another um, sort of mini banking collapse like we saw last March?
The biggest risk does seem to be to the regional banks. Jerome Powell was on 60 Minutes and said that this could be an issue that'll take years to address. Janet Yellen came out and expressed concern, basically saying, yeah, there's going to be pain in some of the banks, but it's not going to be a systemic issue. Some industry analysts are saying that there's as much as maybe $1.2 trillion worth of commercial loans that have properties that have seen their values decline significantly and that are up for renegotiation or renewal, right? Like your loan's maturing and then you need to go and get a new one. Potentially as much as 1.2 trillion this year, right?
Mhm.
So I I mean one of the things that was maybe small comfort was an analyst coming out and saying, well, the global economy is 60 to 80 trillion dollars, so 1.2 trillion is not really that much. It's like, okay, yeah, that's still 1.2 trillion dollars. It does seem very much like this is something that will leave the big banks largely unscathed, right? They'll probably go through some sympathy selling, but that there are going to be pockets, especially in the regional banks, where some just will not be able to continue to operate. A lot of these commercial loans were originally financed on the heels of the great financial crisis. Um, it was all well and good in a period of near zero interest rates, but now that interest rates are higher, you're basically asking borrowers to double the amount of interest that they're paying on loans on properties that are maybe worth 60% as much as they had been 5 years ago or
Yeah.
just pre-COVID. So I do think it'll be a problem for individual names specifically and probably anything with high exposure to regional banks in particular.
Yeah.
It's
And it seems like, unlike last year, where the banks that collapsed were so big that there inevitably a lot of, there was a domino effect with their, banks and companies that had, exposure to those banks. Um, New York Community Bank isn't as big as those, but I think that the risk is more just in the commercial real estate sector itself. Other banks, regional banks, like you mentioned, having, you know, similar problem to what just happened with NYCB. It's not the exposure to NYCB, it's exposure to the commercial real estate sector that probably has some of their balance sheets looking, I'm sure there's some that are seeing what happened there and like, are we next?
Yeah, last year you had a lot of liquidity mismatches that were causing some of the problems, right?
Yeah,
So, investing in longer term, investing cash you need tomorrow in money that you can't access for 10 years,
right.
right? Like that was this big thing with Silicon Valley Bank is that they were making all these loans that um, they ended up needing the deposits for. That's not an issue, but instead what it's replaced with is something that seems to be more systemic, which is the commercial real estate market is struggling right now. It's going to continue to struggle. Um, I don't know that we have like a capitulation this year where everything comes due and it's no longer a problem. It's probably something that takes a while to sort of trickle through, but you know, good management can allocate more towards loan loss reserves. They can start taking write downs at good opportunities. They can sell some underperforming assets, assuming that there's buyers for them. The fear is that you have all the regional banks try and do the same thing at the same time, where it's like, okay, well, if I want 60 cents on the dollar on this loan, that's all well and good. But if the guy next to me wants 59 cents on the dollar on a very similar loan with similar risk profile, then you have sort of a race to the bottom for pricing. And I think there will be pain in regional banks. I personally would stay away from them
Yeah.
unless I had either a trusted analyst that I was following or I had done the work on the balance sheets myself and was looking at it and saying, okay, well, this company doesn't have any significant loans outstanding that are maturing in the next 3 years, for instance. They should be able to weather the storm. The Fed should have rate cuts fully in hand 3 years down the road. But since most people can't do that, it raises a red flag for me.
Yeah. There's too many, you know, too much good in the market right now to even take the chance on a regional bank right
Yeah,
now.
if
Just look at China. There's plenty of good companies there, BYD, which I mentioned, that are just getting crushed because China is not in favor right now as a whole, and I think that's the same with the regional banks. They're not in favor as a whole, and I think that's any attempt to get clever and pick the one or two that are going to survive is sort of a fool's errand right now. But we should move on. Number three, big three, Super Bowl. This is Sunday, and with that in mind, it's a good chance to talk about the boom in sports betting. Legalized sports betting just became legal here in Vermont last month. I'm I started out hot, but
big
I'm a
fish.
cool streak. DraftKings and you wrote about this yesterday. DraftKings and FanDuel are the two biggest players. FanDuel owned by Flutter, FLUT. Uh, it's no coincidence that as legalization has spread and then coinciding with the NFL playoffs, DraftKings up 24% already year to date, heading into the Super Bowl. Flutter up 19.6%. There are smaller players, but I mean, is it just sort of a pick 'em between those two? Are there any others? I don't think there's any others you'd recommend, are there?
No.
Yeah,
I mean, like I can get cute about it, but mostly no. So one thing that Mike Santolo writes about periodically is like when you get this new sector, this new industry, companies try and make a big splash in what he calls the land grab phase, where
yeah,
you come out and you're trying to claim customers. And we saw that with the online sports betting legalization market where companies were coming out and offering like huge bonuses to users, free bets, free money. All you have to do is sign up. The land grab phase seems largely to be over. FanDuel and DraftKings both seem to have come out on top. They've both laid claims to being the number one in market share, although the CEO of Flutter Entertainment, which was previously a European listed company and just listed in the New York Exchange last week, I believe, or yeah, beginning of last week, they came out and said, well, if you look at this other metric, the net gaming revenues based on the state reporting, we're actually number one. So they're jockeying for position. Number three on the list is BetMGM, which has something like a 17% market share right now. They've been losing market share. They were as much as 30%, I believe, in the beginning of 2022 when the legalized nationwide betting trends seem to really get underway. Wynn Resorts has their own offering. Caesars has an offering. They call the segment digital. Penn Entertainment has what they call their interactive segment, which is the same thing. The issue for a lot of the other operators is that they are first and foremost casino and resort operators that also happen to offer online wagering, and they seem to be doing the expensive land grab fight still, where it's like, hey, we're trying to claim market share, so we need to lose money. BetMGM made $13 million last quarter off their digital segment after losing hundreds of millions last year, and I believe 80 million, maybe 50 to 80 million just in last year's third quarter on the endeavor. So they are fighting an expensive fight for third place. It's really Flutter or FanDuel, or I'm sorry, it's
Yeah,
really Flutter or DraftKings. So those are the two horses, those are the two contenders. I think either one of those is probably a very good play, but the other
right.
ones are a bunch of also rans.
Yeah, I mean, and I don't think it really even matters which one you pick. Just so anecdotally, like I mentioned, legalized here in Vermont at the beginning of the year, early January. Um, Most of the people I know, so the deals are you put in $5 and you get $200 worth of bets, free bets, with both DraftKings and FanDuel. So people aren't just choosing one; they're doing both. There's no real distinction that no one cares. I was like, I'm loyal, at least starting out. I'm loyal to DraftKings or I'm loyal to FanDuel. I'm sure, a year or so down the road when people run out of that original $5 stake runs out and they have to put more money back in, they'll probably choose one. But right now, they're as you said, they're arguing over who has the bigger share of the legalized sports betting market. It's sort of you know potato kind of a thing. So you could pick either one. One thing that we should pick: who's going to win the Super Bowl?
Chiefs. I hate saying it.
Probably. I
Chiefs.
agree. I
I don't
agree.
know. Like
Yeah,
this is why I
I'm
didn't
tired of
like the
betting against them.
I,
Speaking of Vermont sports betting, I did not win money on betting against them with the Ravens, and
I
yeah,
thought the
not
Ravens would handle them easily.
yep,
It's very much approaching like the Brady era dynasty level with the Chiefs, where it stops being fun to watch, where they
yeah,
just it's like, all right, yeah, the Chiefs are going to win another Super Bowl. Great. San Fran's got like all these great stories, but you got Mr. Irrelevant helming the team. Uh, and KC's going to chase him back to San Francisco again, like they did in Super Bowl 54 just a couple of years ago. It seems like just a foregone conclusion, which makes it less fun.
yeah. Fun for the Swifties though, which is
One,
Taylor
everybody.
I'm
Swift
gonna,
is going to get engaged though, so you should be very
That
excited,
might
Brad.
happen. Yeah, that would be. I mean, what better timing for him, right? That's Madison Robertson, our producer, joining us. Yeah, well, I assume Madison, you're rooting for the Chiefs because of that
No,
potential.
I mean, no, I mean, I'm not one of those like psycho fans. I think she's cool, but I'm not a lunatic about it. So I didn't start watching football because Taylor Swift goes to football games now. Target did just release a shirt though that says "Go Taylor Swift's boyfriend" in Chiefs colors. That gave me a good
that's
laugh.
funny.
That way you don't have to update it,
Oh,
when they, eventually
when
break
they
up.
break up, it's like, yeah, I'm
Um,
just a big
yeah.
John Mayer fan,
Right.
or whatever.
Yeah,
Uh,
Jake Gyllenhaal.
Before we move on from the sports betting thing, I do want to throw a name out there that is not public yet, but might be worth investing should it become public in the future. It's a operation called Underdog. It is a sports betting and daily fantasy platform that is really engaging, and I know a lot of people that use on a regular basis, not publicly traded. If you see that it's coming public, that might be one that could actually make a splash because it's got a differentiated product than what you're getting from your DraftKings and your FanDuels of the world. Um, I believe it has venture funding, but that's it. So if you're looking for something to sort of be smarter than the next guy, don't go by Win Resorts. Keep your eye open for Underdog.
There you go. And by know a lot of people who use, you mean
Oh
you
yeah, wagered hundreds and hundreds of dollars on Underdog.
There you go. Okay. Let us move on to our guest for the day, and that is Michael Brush, who is Chief Analyst of Cabot Cannabis Investor. We'll take a quick break, and Michael will join us. Okay, we welcome in Michael Brush, Chief Analyst of Cabot Cannabis Investor, who's been on several times. But Michael, I think we had you on August, September, right around the time that there was a big pop in cannabis stocks right after the HHS recommended rescheduling cannabis from Schedule 1 drug lumped in with heroin, acid, other terrible things to a Schedule 3 drug. Now, and there was a big spike, and then it sort of came right back crashing to earth. But it's been interesting the last 2-3 months. It hasn't exploded the way it did then, but it's up, 25%, 26% year to date, or sorry, 17% year to date, 25% in the last 3 months. And it's not pulling back. It seems like there might be a little bit of belief in the industry now. Is that your take? And B, what are people looking forward to most, would you say?
Right. Yeah, that's true. The gains this time around seem to be a little more sustained. They're holding.
Yeah.
And I believe that's because we all think there's a pretty big catalyst right around the corner. That's always been the case with this sector, and it's always been a disappointment to think that. But this time may really be different. And so you have the rescheduling, and the HHS, as you noted, made that suggestion. And in the interim, thanks to the work of Shane Pennington and Matt Zorn, all the full documentation came out, and it's pretty substantial. They make a pretty substantial case for rescheduling down to Schedule 3. So that's pretty bullish. They make a convincing case, and this sort of made everybody think, well, maybe this one actually is real. And so the next step will be the DEA has to publish in Federal Register what's called a proposed rule. And that'll be the next really big catalyst for this group. And the timing on that is unknown. But for all of this to happen in time for the election, which is really kind of not likely that it will if you take a step back and look at history, but it's politics, so anything is possible. Yeah. For the timing to work, for Biden to be able to use this as an election instrument, which is obviously the game plan here, the DEA rule has to drop in March or by the middle of April. And so anyway, that's why people are holding on. This sector is still super volatile, but on a new level now. Yeah. So
one thing that, following on that point that we've seen a lot is like, okay, well, we sell out of rallies instead of seeing investors buying into rallies. So I think having an actively traded portfolio has probably served you well. You've been outperforming MJ and the New Cannabis Venture Index Fund. Is that?
Yeah, that's right. The Global Cannabis Stock Index. It's got quite a name, but yeah, right. So that's right. Yeah, we're up as of the end of January. It's a little lower now, but we're up 35% in the main portfolio versus 14% for the NCV index, and I also have a Cannabis Plus portfolio. These are companies that don't touch the plant, but where there's interesting insider buying. So I launched that March last year. That was up looking at 39% versus 22% for the Standard & Poor's 500 and 12% for the R2K. But sorry, I cut you off, but I think you're saying that there's crazy volatility here, and what should we do with it? And that's really the right question, I think.
Yeah, that's exactly what I'm looking at, because I remember in the August and September rally that you were advocating for sort of actively trading the rally, taking profits, and being opportunistic with it. Are you still broadly positioned in the same way now?
What I've been telling subscribers, and it's really worked out. Look, I'm not a good trader, and I honestly don't think most people are good traders. It's just, you sell a little bit too early, so you buy back because you regret it, and then the pullback happens, and now you're even worse off. I mean, there's all sorts of things that can go wrong when you're trading. As a fund manager once told me years ago, You win a nickel, win a nickel, win a nickel, lose a dollar. And so that's, to be a good trader is really tough, and it involves a pretty high degree of luck, in my view. So I have been saying during peaks, if you think you're a good trader, or if you are a good trader, this might be a good time to sell. But really, the way I'm doing this personally, and also in the letter, is whenever we've gotten to extreme lows, I've been saying this is a great time to buy, add here. And then when we move up, I say this is not such a great time to buy, maybe a little more hold or sell if you're a trader.
Mm-hmm.
And so using this strategy in my personal account, in my MSOX, which is the leveraged MSOS, this morning I was up 77% in that, just by never selling but only buying the extreme weakness. It's sort of a contrarian strategy, which I like to use.
You mentioned rescheduling being the biggest potential short-term catalyst, and might be what Wall Street's sort of latching onto, with
Right.
March, April being potentially when that would happen, or when the DEA might approve it. Safe banking, the Safe Banking Act has been another potential catalyst in the past year or so. It seems like it'll get some traction, then it doesn't. Where does that stand? Is that another one in the hopper that's possible this year, or is that sort of faded?
Yeah, who the heck knows? I mean,
Oh.
we've gotten so many miscues on that one. And the so-called experts, the lobbyists, they're up there every day on Twitter doing their vote counts, and they make a prediction and they're wrong. It's just really hard. Half the battle with investing, I've always said personally, it's never a good idea to have the government as your partner as an investor, and that's exactly what we have here. As a journalist and as a writer, it's really fascinating, because you can now enter the world of politics from the world of balance sheets, which are also fascinating, but in a different way. But it makes it wildly unpredictable, because politicians are unpredictable. They have their own agendas, and they change depending on where the recent donation money and so forth. It's just. But anyway, to answer your question, it's been approved in the Senate, the House. Who knows? People are saying it may happen. But that's it's always been approved in the House, and the same people who have approved it are still there. But it's now, in conservative hands, and conservatives are less likely to favor cannabis reform. So that one's a big question mark. It's possible, but who the heck knows, really, at this point.
Yeah, of course. I mean, you have to wonder. It's like, okay, well, does this look like giving the other side a win if you approve this in an election year? That obviously is impacting
Right.
more important legislation than just whether cannabis companies can use banks and investments,
Yeah.
and can write off taxes. So it seems like something that might have less impetus to pass this year, just to me personally.
Well, that's true. And also, rescheduling there, the ball is in the court of the administration. They have almost full control over that, because they control the administration and the DEA, and the DEA is part of the Justice Department, and they control that, and they can kind of say, hey, we want this to happen, which, by the way, is kind of what people want. Polls show Democrats consistently favor legalization, and now we see that Republicans under the age of 55 favor. So the DEA, so the rescheduling seems more predictable, and so that's why we're all kind of focused on that catalyst right now. Biden needs it. He's losing he's losing all the Democratic core constituencies are kind of creeping away from him here, whether it's the Black vote, the Latino vote, or the youth vote, so he needs cannabis more than ever. The issue is that they need to do it right, because if you rush it and you don't get all the procedure right, which, by the way, involves like a 90-day comment period, and there's a judicial administrative judge that has to review complaints. Like, if you don't do all that right, it'll get overturned in the future. So there's a whole timely process and time-consuming process that needs to happen. And normally this has taken 9 years, what they're trying to do right now. And they're trying to do it now in basically a year and a half, which, seems remarkable. But like I said before, in the world of politics, anything is possible.
Now, one other catalyst that I think that I'm curious about, because you had mentioned NATO earlier, is international legalization. Oh,
Right.
I'm sorry, UN. So one thing that you have talked about in the past, in your letter at least, is expansion internationally, with Germany potentially offering some decriminalization or legalization options. Are you seeing any developments internationally, so outside the U.S., where it's a political rock fight right now?
Yeah. Um, Well, yeah, absolutely. There's really amazing progress towards reform in Europe, and it's happening and it's real, and not a lot of people are talking about it. And we know the companies that are well positioned there to benefit, and they're in our model, they're in our portfolio. But certainly Germany, Germany is moving ahead pretty quickly, and other European countries, Poland, Czechoslovakia are also moving. Germany's kind of taking the lead, and they're providing a template on how to do it. It's gradual, but that's a big market. That market is as big as the U.S. market in terms of population. So that'll be huge too. And you're right, nobody's talking about it. We were talking offline about the UN. They do like an annual drug report, and cannabis, I'm not advocating use, but cannabis is the most popular drug on the planet, which is really quite remarkable if you think about it, considering how illegal it is in most places.
Above alcohol, right?
Yes,
Yeah,
yes.
that's the basic. That blew my mind. Yeah, I mean, I guess that's a good thing, and that's you know that makes you think that rescheduling is an inevitability here with the DEA and just with the political pressure that you mentioned.
Yeah. Our country is divided in so many ways, and it always has been, by the way. This is nothing new. If you think about, Prohibition, the Civil War, the 1968, but certainly one of the ways that the country is divided is, alcohol use versus cannabis use. I know that there's a middle zone. There's a where people use both. But
Right.
that's just another division. But the cannabis crowd is very strong, and they vote, and there's a majority that wants reform. So this whole kind of politicization of cannabis, which has been really strong since the 1930s and before, probably, maybe that matters less now because more people seem to favor it. I don't know. We'll see.
Yeah. Um, Before we let you go, your area of expertise with Cabot is cannabis, but you write about a whole variety of subjects, market related subjects. You have a column of Market Watch. Is it Brush
Mhm.
Up on Stocks?
That's my letter, yeah, and
That's
then
your letter. Okay.
right, and then there's a Market Watch
Market Watch
investing
column.
column. Yes.
Right. Anything else in the market that interests you just from an investment opportunity right now?
Mhm. Well, I mean, right now, I think the banking sector is quite interesting. You mentioned the New York Bank offline,
Yeah.
which blew up. I believe that probably survives, but that's not where I would go. I think it's more, what's interesting in the banking sector is that as we saw in March and April when it really blew up, the insiders have come in a big way. I follow insiders quite a bit, and the banking insiders have really come in a pretty substantial way to buy this pullback. So I think the banking sector looks quite attractive here. The shorts have really ganged up against banks, and so if we get moving to the upside, that'll provide fuel for the rally. But I'm not really thinking of it that way. It's more like a lot of these regional banks pay 4 or 5% yield. So even if you just sit there for a while, you're still making money. But yeah, that's one sector. Tech insiders in tech are a little bit cautious here. Not the Mag 7, but in kind of the rest of tech. So that's where I would be a little bit cautious here, going by the insiders. And then sentiment is always a huge debate, but right now I think sentiment is bearish enough so that the market can climb higher. I don't think there's too much bullishness in the market. So that would be my kind of high level summary of other topics.
Yeah, you hit on some subjects we talked about right before you came on. Yeah, that's sort of been the theme when we've had analysts on here, Cabot analysts on here in recent weeks. Be like, okay, is it too bullish? Are we the right amount of bullish? And that's been sort of everyone said, yeah, we're okay now. We're okay now. It's not, you'll know when exuberance is set in too much. I started the show talking about I thought there might be a little much in tech, and we could see a pullback in the S&P/Nasdaq, but in the an ascendance in the equal weight index, which is flat for the year. just from a sector rotation standpoint. Who knows? But every time you tried to bet against tech in recent months, it's sort of blown up in everyone's faces.
Well, I mean, I own the Mag 7 and I'm up quite a bit in those names because
Right.
I was buying them back in the end of 22 and early 23 when everybody hated them. Again, a contrarian approach.
Yep.
But I don't know that I would add to those here, but they're long-term holdings for me. So I kind of agree with you there, but I'm not selling them either. And sentiment is always a tricky thing. Bank of America had a real interesting headline 2 weeks ago. They said everybody thinks everybody else is too bullish. And if you think about that, that's really a clever way to put it, because people reading sentiment are often sentiment indicators themselves. Like 2 weeks ago, there were a bunch of notable personalities, I'm not going to name names, who were sort of saying, oh, everything's too bullish, and that was in January when the market was down, and since then we've recovered. And I kind of thought that might happen because to me there wasn't excessive bullishness, but sentiment is really tricky to read. And I think one of the best things you can do is watch yourself. Like, we all know our own emotional reactions to how the market moves, and I think we all are our best sentiment indicators. And I have to say, I mean, it sounds stupid, but a lot of people say this. I mean, a lot of the best purchases I've made in my life have been the hardest ones to make. And I think that's a good kind of a way to judge whether, what you're about to do makes sense or not. Like, if it's really easy to buy, it's probably not a great time to buy. If it's really hard to buy, that's probably a good time to buy. Again, using yourself as your own best sentiment indicator.
Yeah, that's interesting. I've never considered using just the virtue of, are people worried about sentiment, right? Like, if I'm worried that other people are too bullish, I'm obviously not in the exuberant camp. And,
Right.
certainly anecdotally, we're not seeing people like leveraging their accounts to the hilt. I think margin balances are still pretty suppressed right now. You've still got a lot of cash on the sidelines. One thing that sticks with me is I remember you saying, I don't know, maybe October of last year, hey, markets climb a wall of worry, and
Right.
this is what it looks like. And I think you've been certainly proven right, internally at least. I don't know that that was on the podcast, but that's an interesting gut check, because I am certainly guilty of coming out here and thinking like, yeah, everybody else is too bullish, but I'm the smart one that's not. But a lot of other people, I think, are probably in that same boat.
Yeah. I mean, to try to get the call right, I track about a dozen sentiment indicators, but there are a few that I look at more than others. And one of them is the Investors Intelligence Bull Bear Ratio. I didn't see the number for this week yet, but we're at about 3.5 on that, 3.5 on a scale of 1 to 5. And the way I use that, above 4, I start to get cautious, because that shows a lot of bullishness. Like, above 4 is enough of a deviation away from the norm. And above 5, let's just move to cash. There's probably some more upside, but especially if the market breadth starts narrowing, like, that's the killer combination for a market. Really high bullishness, investor intelligence bull bear ratio at 5 or above, and then the market is super narrow, because that tells you that a correction has already started to happen. It's just not evident yet in the narrow indices like the S&P 500 or the Dow that most people look at. So most people haven't gotten shaken up yet, but they will. So that's and another one that's real interesting. Bank of America tracks what they call their sell side indicator. So they look at the strategists on the sell side and their allocation to cash versus stocks, and that indicator is still very cautious right now, very, very cautious. And that's a good indicator to follow that, not a lot of people talk about, which is one of the reasons I like to use it.
Michael, really good stuff. Thanks again for
Thank you.
joining us. And as I mentioned at the top, Cabot Cannabis Investor for people who want to sign up. We'll include a link in the blurb on YouTube. It's also on the cabotwealth.com advisories page. It's a good time to be investing in cannabis, and it's an even better time to be investing in your newsletter, because, as you mentioned, you've been outperforming through the first month plus of the year. I think you said 34% through the end of January.
Right.
A great time. I think good things are coming down the pike, it sounds like, for cannabis, and it seems like a good time to invest. So thanks again for joining us.
Thank you,
Yep.
gentlemen.
Yeah, and we
Thanks.
will be back with next week with another episode of Street Check. See you then.